This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. Welcome to Bazaar Morning Call. I'm Sonia Shenoy. You're joining us live from the CNBC TV18 Motilal Oswal studio. It is the start of a brand new year. Happy New Year to all our viewers. I mean, of course, yesterday was the first day of the year. So whoever's back after the holidays, I wish you a very, very happy 2024 and hope you have a great year similar to what we saw last time around. Today I have with me Nigel and Surbi. Folks, Happy New Year to both of you. This one's going to be a great one.
Happy New Year and welcome back, Sonia.
I know. We had a fair amount of action and drama yesterday itself playing out because the market's been anything but quiet. I can tell you that. The usual last end of the year scenario that plays out, that's not been the case because we've got FII money coming in, markets making fresh highs. And yesterday we had an intraday fresh high. Then there was a bit of a shakeout. But I can say it's been anything but quiet, actually, in these last couple of days of 23 and the first day of 24.
Absolutely. And, you know, I was in Dubai for New Year's and there's so much talk about India now, not just in the Indian equity markets, but in the Indian real estate market as well. And I think this chatter has picked up significantly over the last 6-7 months. I was trying to find out the reasons for that. And people were telling me that people in India have, all over the world actually, have made so much money in the Indian markets that now they want to sort of, you know, move out or expand. So people are moving from India to Dubai as well. So lots happening. I mean, India seems to be the focal point of everyone's discussion.
You know, Sonia, that's what makes it a little tricky, right? Because at the start of 2023, you were saying, we'll enjoy some bit of a party, it's fine. At the start of 2024, you want to party. You're saying that 2024 belongs to India. India should do well, which makes it a little bit tricky. But in a longer term, I think in the next few years, you know, it belongs to India. I think I put out this piece yesterday as well on social media that we're talking about India, you know, earlier we were talking about +1, and that's why India gains. India is moving to the only one, maybe. So let's see how that works
Expectations are high now, so perhaps that also leads to disappointment. But anyway, we have lots to talk about this morning, so let's get straight to that. The market momentum continues to be quite strong. There's no two ways about that. 2024 has begun with a considerable amount of outperformance from the mid-cap end of trade. So I don't know whether that will be the trend, but at least that's something we've noticed in the last couple of days of this market. There's a big rally that we've seen in the chemical names, in metal stocks. There are some upgrades that have come in on metal stocks this morning as well. So that will be the key focus area for me. Remember, dollar and bond yields continue to fall, so keep an eye out on that piece. Apart from that, the next trigger, of course, will be the technology earnings. You have both Infosys and TCS coming out on the same day. So keep an eye out on those stocks. January 11th is when these numbers come out. So that will be the next trend setter for the market. And, you know, we have some strong operational data that's coming from the likes of Coal India, etc. Nigel will talk about that in a bit. But apart from that, the overarching theme is that this market has done a lot of work in the last 1 month. In fact, the Nifty is now up 1,000 points in the last 1 month and seems like that momentum could continue. The Dow put in almost 14% in 2023. The Nasdaq put in 44% in 2023. And now perhaps they could build on to those gains as they kickstart trade later this evening. Yesterday, there was the tsunami warning because of which you saw that intraday dip. But I reckon that could be used as a buying opportunity in the market because, you know, that's been the case so far. This morning, the GIFT Nifty is suggesting a very, very flat start, perhaps consolidating around this 21,500 mark. But I think every dip will be used as a buying opportunity, as has been the case for the last many months.
No, absolutely. And I think that's what we, we need to see, whether the dips keep getting bought or not, because that's been the texture and the nature of this market, right? I just want to say that for me, this volatility that's been rising, so I went back and just checked the wicks out over the last couple of weeks. And it's interesting because as the market has been riding higher, so has the VIX, which is usually a sign that people, take on board with some caution. Rising VIX usually gets people a little nervous. So in November, we were at about 11 thereabouts on the volatility index. That number moved up to all the way to 15. We're around about that level even now, 14.5 thereabouts. So volatility perhaps has become a bit of a reality as we are dealing with elevated levels. So that kind of is par for the course. And therefore, we need to be a little mindful of the mini shakeouts. Look at what happened yesterday. The market hits an intraday high of 21,834 to be precise. Within 60 seconds, there's a turnaround and a very, very sharp one at that. And we had a complete reversal come through. So, yeah, that's good we brought up the intraday graph. That's the picture. So we need to sort of keep the guard up, I guess. That's something to take home. In terms of, more numbers and cues, The FII number yesterday turned negative for the first time in 4-5 sessions. I mean, that's what I was saying. The last week of December was, anything but one to forget, because we were getting 3,000 crores, 4,000 crores of money every single day. Yesterday was the first negative day, because we were discussing this earlier, that the year-end phenomena could have been that NAV adjustment, particularly on the index fund side. So maybe some, adjustment of positions taking place. Most of the global markets are resuming work, coming back. So we'll have more clarity on the FII numbers and whether the flows can continue. This huge number of 66,000 crores of December, whether we will see more of the same or not in January, that's something to watch. By the way, in terms of macro data points, as markets come back to work, we've got the manufacturing numbers from China. China's picture continues to be as bleak, because the official PMI number that's come in, manufacturing PMI, it's showing more contraction. 49 is the figure, 3 straight months of contraction, and it's worse off than November. Anyway, usually China's pain has been India's gain, so we see if that plays out to our advantage or not. Finally, sector rotation has been very evident in this market, and we saw more of that yesterday as the market positions for the next event, which is earnings, IT. There was some buying in IT coming in. Autos, there was a sell-on news play out. Anyway, the December numbers weren't anything great to write home about, mostly missing expectations for most of the manufacturers. So money rotating out of auto going into IT. But, for me, folks, it's all about the banks, and we've been discussing that with all our guests. That's the big, trade of 2024 that's supposed to take off. The thing is, we have it's 2 steps forward, 1 back. That's been the story with the banks. So whether we can get consistent outperformance on that big index, the Nifty bank, I think that's going to be one of the big points that I watch out for today and the rest of this week.
I was off towards the end of the last year, and people say that the FIs went on the break. But periodically, I was just checking what are the FI flows. It appears they didn't go on the vacation.
I didn't feel like a vacation at all.
The kind of money that was coming in. But, I think to get a better trend in terms of what the FIs are doing, we'll have to wait for around 2 to 3 trading sessions. And then, we'll see flows come back as well. For the time being, for the next 2-3 trading sessions, volumes will be subpar. But what you could gather by looking at yesterday's screen as well, the Nifty is facing resistance at higher levels, and that's why we're seeing some bit of selling at higher levels. Mid-caps, yes, that's the theme that has worked out very, very well. But in select pockets, some caution could be warranted out there, because there are select stocks that are moving up, and maybe it's not fundamentally back. So just be a little bit cautious in the broader markets. Some caution never hurts. Now, the financial services, the Nifty Financial Services Index, that plays out its weekly expiry today. So that's going to be one of those indices that we'll be tracking. For the Nifty yesterday, everything looked good, right? Everything looked good till the final 60 minutes. And the intraday chart will tell you. So till around 2:30 p.m., if you logged out, you would say, wow, what a good bullish start to the year. But in the last 60 minutes, the Nifty Bank, the Nifty Financial Services Index, all of them did come off the top. So, at around that 21,850, it appears we're seeing some bit of resistance that's coming in there. But the mid and the small caps, yesterday as well, they outperformed. The Nifty ended more or less flattish. Both those two indices went home with gains of close to around 0.5%. But select pockets out there are looking a little bit frothy. How the FI is positioned? Well, they're net long. We have been making this point. That in absolute terms, it's 80,000 long contracts. In percentage terms, it's around 69%. I always prefer a market that's net short. That gives you that additional booster shot. But for the time being, we're net long, so let's see how that goes. You don't want that, the net long positioning to go to around 100,000 contracts odd. We've seen when that happens in the past, we see a bit of a pullback. Options data, 2 active strikes out there with the highest amount of open interest, 70 lakh shares apiece. Now, getting to the numbers, you're just going by the options data, going by the trading action we saw, 21,850, 22,050, going by the options data, becomes a bit of a resistance zone. On the downside, since the 21,700 put has a fair bit of open interest, the premium's around 70 rupees. You have 21,670. That becomes the near-term support zone. The GIFT Nifty was suggesting a bit of green, I think, to kick start trade after yesterday's pullback. In fact, now it's suggesting that we pull back close to around 30 points odd. I think that 21,630 should hold out. If that holds out, then maybe we make another dash towards 22,000 odd. But it seems the next few days we could be in this range of around 250 to around 300 points.
Okay, all right. So we'll watch out for the way those cues shape up. Right now, let's get started with the equity call of the morning. Mahesh Nadurkar of Jefferies says, resurgence of a multi-year capex upcycle implies robust 6 to 7% GDP growth over the next 5 to 7 years. Potential slowdown in government capex in the upcoming budget is not a worry. Foreign investors' positioning on India is light, and calendar year 24 should see greater inflows, which should help banking stocks. They like domestic cyclicals, that is banks, power, telecom, industrial, property, and they're underweight on IT, consumer, and energy. They've also increased the underweight positioning on consumer and raised banks to an overweight. For stocks, Jefferies has trimmed positions in L&T and added Adani Ports.
Okay, interesting views coming in on the money markets as well this morning. On the rupee, Abhishek Goenka of IFA Global says that as we step into 2024, the flow pipeline looks quite promising. As financial conditions ease in the US and Europe, we should see a steady stream of FPI flows into domestic equities. If crude stays in the $70 to $85 per barrel range, the current account deficit too should be comfortable. Overall, he expects the dollar to trade with a weak bias in 2024 and the rupee to underperform amidst broad dollar weakness. According to him, the RBI will likely continue to wield significant control in 2024, as well as it keeps absorbing inflows and accumulates reserves to enhance external stability. The medium-term trading range for the rupee, according to Abhishek, is at 82.70 to 83.50 to the dollar.
Okay, on bonds, Ajay Magnolia of JM Financial says demand in the last auction has firmed up yields, but volume was low yesterday. Stability of economic parameters like inflation, the current account deficit, low crude prices and better tax collections is comforting despite low liquidity in the system. He expects the 10-year benchmark yield to trade in a range of 7.18 to 7.22% for the day.
Well, we've got a lot of stock-specific action to track for you. Get at that in just a bit in our special Top 10 segment. For the time being, we run you through the list. We're looking at Coal India, TVS Motors, Power Grid, Gensol, we have SRF and GR Infra. All of them will be reacting to positive news flow. While on the flip side, Ultratech Cement, Eicher Motors, APL Apollo Tubes, South Indian Bank will be reacting to negative news flow.
Okay, so we'll get to all of those stocks in just a bit and tell you more about our top 10 list. But for the time